there's such a fine line, making money and losing money in the market.
We want to teach you the concepts.
You have to be okay with the type of trader that you are.
We want to teach you the processes.
This is what really gives the meat and potatoes to it.
We're going to teach you how to.
The bottom line is you want to make money trading.
I can promise you that I can make you a better trader.
Join T3 Live at the Boca Raton Hotel and Resort April 26th and 27th for a free trading education event. Call now.
Good morning, everyone. I'm T3 Live Editor-in-Chief John Darsie.
And I'm Brittany Umar, and together we bring you Morning Call. So futures are up slightly this morning after markets rested yesterday following a 3-day bounce. So we'll have to see today if that'll continue.
Yeah, like you said yesterday, the markets just seem to be resting after a nice 3-day snapback from the 50-day moving average on Friday. It's very healthy action for this macro uptrend. And one thing we talked about is the market did break some more accelerated uptrends. We saw some faulty signals in the market that looked like they could lead us lower, but as we've seen throughout this entire year, the market bounces off key levels. It holds where it needs to, whatever you want to say about that. And the more macro uptrend held, the 50-day moving average held, like I said, and a lot of those faulty sectors have been helping lead the bounce.
And we are seeing a lot of sector rotation. We're starting to see sectors that we had previously looked to for clues that we could head lower, like the home builders and the financials, that are actually bouncing back. So what does that tell you about the strength of the market that we're seeing?
Yeah, I mean, like you just said, we had sectors that we were pointing to as faulty signals in the market. We had the home builders, we had the financials, we had the transports, the small caps. These are all sectors that they were part of our thesis about why we could head lower in the market. And those are ones that have been leading the snapback. But first, I'm going to go ahead and take a look at the S&P chart. We can take a look at the levels. And after this 3-day snapback, we are back above all the short-term moving averages after bouncing off that 50-day. As you can see here, we have this macro uptrend drawn from the November reversal, and we held that, like I said. The more accelerated uptrend here got broken, but it's unfair to expect more from a market than holding a more gradual uptrend rather than an accelerated uptrend. But we're back above even this pivot right here, and the only thing in our way now is all-time highs again. So it'll be interesting. Traders will be watching to see whether we challenge that high again, whether we maybe form a right shoulder. People have thrown out head and shoulders patterns in this market. Whether you think those are valid and important or not. But traders are sort of in wait-and-see mode with the S&P. In general, I don't think there's a ton of edge trading the S&P or the broad indices. I think you should take a more stock-specific approach, take a sector-specific approach, and I think you can generate alpha as opposed to this market. It's a little bit hard to chase up, 10% for the year so far, but I think if you take a stock-specific approach, you can have better results. And we'll go ahead and take a look at some of those faulty signals that I talked about that are not becoming faulty anymore. They're sort of flipping the script on us. You have the home builders that on that Friday, it was below all of its key moving averages, the XHB, the home builders ETF. Bounced back up into its 8-day, and then the following day we had weak existing home sales data that looked like it was going to create a rejection at the 8-day moving average. And as you can see from this tail, we traded sharply lower that morning, but we got a very swift snapback, and we closed higher that day, and the XHB hasn't looked back, and now it's above this pivot. And just like the S&P, all it's in its way now in terms of resistance is all-time highs, or not all-time highs, but 52-week highs for the XHB, as you see right here. The financials, another one, XLF, it was one that we thought potentially could lead the market lower. You had a round of earnings from that group that they were solid earnings. They beat estimates, but the street didn't like them, and they sold those earnings. But it was able to hold this upper level floor right here, and now we're back 52-week highs in the XLF. Like we said, those are some faulty signals that we were seeing in the market, and now they are part of the reason why we're back with our sights set on highs in the S&P.
Right, so just like we look to them as clues that we might head lower, maybe we can look to them as clues that we're going to keep going higher.
Exactly.
Well, another sector looking good is mega cap tech. Microsoft checking on another 4.3% yesterday. The stock has really been on fire.
Yeah, we talk about sector rotation. That's been the key to the market sustaining, in terms of the broader indices, sustaining this macro move, is that you've had, at various points, we've highlighted faulty signals, we've highlighted sectors that could potentially be evidence that we could get a deeper correction this time around, but every time we've said that, we've had money rotate, we've had some sectors that were previously out of play emerge, and that's what we've seen with mega cap tech. Microsoft, as you mentioned, if we take a look at the chart, it tried a couple weeks ago to make that move. There was no real catalyst for this big 2-day move besides potential sector rotation, money rotating, people looking for stocks that aren't into orbit already with this market at all-time highs. And basically after this 2-day move, you got a very weak PC sales report, and then Goldman came in the next day with a very harsh downgrade of Microsoft and several stocks in the PC sector. And so you basically had a week or two of Microsoft basing back to where it broke out from, and then you saw the money decide, I guess, maybe that they didn't care about that PC sales data, they didn't care about that Goldman downgrade, and Microsoft has emerged again, had a very strong day yesterday, as you can see. And if we go out to the weekly chart, we can look at a more macro look at Microsoft, and it's one that's not extended, obviously, and looks like it could have room and has a nice dividend yield. It's very liquid, all that type of stuff, a lot of cash on the balance sheet. So it's one that potentially people could be looking to park some money in. And we have this pivot up here around 33 now that could be the next level. Traders are watching for momentum.
Yeah, there are lots of noteworthy names within the sector right now, especially YHOO. Also had a nice 4-day move.
Yeah, YHOO's another one that it had earnings. If we go to the chart here, YHOO had earnings, and if we go back to the daily on that, we can see it had a pullback into earnings. The big reason why YHOO's been rallying so much is I think people are buying into the changes that Marissa Mayer is making, the new YHOO CEO, who's a former Google exec, has come in, and she sort of cracked the whip over there. She says, no working from home, and we're gonna become the company that we can be and fulfill the potential that YHOO is. And for so many years, you had sort of poor leadership over there, and YHOO does have a lot of potential, and it's been more of a speculation type trade than one based on the numbers. And on earnings, that it confirmed that thesis, and we saw a trade down on earnings. But I think people, like I said, are buying into the story more than the numbers right now. They think the numbers might follow. So we held the 50-day moving average in YHOO, and it's back up to 52-week highs. And I think YHOO is one that I think could have significantly more upside. It was one that Scott and I wrote about in his 2013 predictions post, and it's another one in big cap tech I think money will continue to rotate into.
Seems like there's a lot of believers in Intel as well, because the company reported inline earnings numbers and then had a 7-session winning streak.
Yeah, Intel, similar type scenario as Microsoft, is that it started to perk up very nicely a couple weeks ago, and that Goldman downgrade came in after the weak PC sales data, and it took a momentary rest, but then it broke back above, and it's seen, like you said, a nice 7-day win streak. Now it's above all of its short-term moving averages and above its 200-day moving average. You can see it coming in here and actually starting to curl up a little bit. So that's very healthy action for Intel. And the same type of scenario as Microsoft. It has a nice yield. It's become sort of a dinosaur of tech, but people are looking for safe places to put their money that actually has some yield. Bond yields are very low. You have a lot of stocks very extended, and Intel's one that has plenty of room back up to its 52-week highs. Around here at 29, that would obviously be a big move. The next level to watch is around 25 on Intel.
All right, well, coming up, we're going to go in the trenches with Biotech, where we're seeing some faulty action. But first, a quick commercial break. We'll be right back.
I'm Mark Sperling, Director of Trading with T3 Trading Group and contributor to T3 Live. Do you trade on your own, but you wish you enjoyed the benefits of a large trading floor? With the T3 Live virtual trading floor, we deliver that experience to you on your computer. On the VTF, you can follow the long and short positions of experienced professional traders like myself, Scott Redler, and others, and listen to our live radio stations as we navigate the markets. In addition, you get the added value of a large community of sophisticated and like-minded traders. Your membership to the virtual trading floor also includes access to our 2 very popular newsletter products, Off the Charts and the Price Point Sheet, at no additional cost. In my opinion, joining the room will be the best trading decision you will ever make. I would like to invite you to begin your membership with a 7-day free trial. To get started, visit t3live.com and click on the Virtual Trading Floor tab. Have a great day, and I look forward to seeing you in the VTF.
The trenches with Biotech, where we've seen some faulty action after AMGN reported earnings on Tuesday. So after a big run in this sector, now the question is if it's due for a rest.
Yeah, I think yesterday AMGN was obviously the big driver for the corrective action we saw in the biotech space. And we continue to talk about sector rotation as being the key to this rally, and money for a long time was rotating into those biotech names, and it was a place that people were looking to park money and potentially look for some yield and some price appreciation. And you had big runs in those names, but the AMGN earnings were extremely poor, and that stock was down almost 7% yesterday. If we go to the chart of AMGN, you can see this sharp pullback after it was, nobody really saw this one coming. It was up here at highs. You know, it's, in the context, it looks like it's at all-time highs for AMGN, just roaring. If you look at the monthly chart, you see a huge tail for April on that now after the recent action. But we go back to the daily now. Yesterday, it gapped down and it traded lower from that gap. It looked like it wanted to bounce a little bit early but couldn't hold it. Got rejected at the 8-day moving average, also closed below the 21-day moving average. And now it's come into some key support right here. You have this support area that's around 103, 104, and that's going to be a really key area for AMGN because, as you can see, you sort of have a pivot right there, but once you break that, there's not a lot in the way. You know, it looks like almost a 10-day win streak right here. And then the next real major support area, I guess you have the 50-day here down at probably be about 98 if we did approach it. But then besides that, you're below 95 for the next support area. So that's an area that AMGN, there are people are going to be watching AMGN very closely for.
And several names were dragged down by AMGN. CELG was one of them, lost 6%, broke below its 8 and 21-day moving averages for the first time since January. So where's next support?
Yeah, I don't invest in or trade these names too much, but we can obviously look at the levels because in general the biotechs and pharmaceutical stocks are volatile because of the nature of drug approvals, and you can get caught in a 50-point gap up or gap down in a biotech name based on whether the FDA approves or rejects a drug or new data comes out on a drug they're producing. So like I said, these are not a huge one. I trade, because I'm more of a swing trader, but short-term guys have been looking to this sector for volatility, and I know a lot of guys were trading CELG yesterday. If we go to the chart, the AMGN earnings really put a damper on the whole group, like Brittany said. We closed below the 8-day with this wide range bar. Actually closed just below the 21-day, but we're near the 21-day, so it'll be interesting to see whether we hold that, because it also coincides with sort of an upper level floor here in CELG. We could get a move down to the 50-day moving average if people continue to sour on this sector a little bit and money rotates into other areas, but we do have a cluster of support here, so if we do get more downside, I think the 50-day is an area to watch on CELG.
And we should note Biogen reports before the open today. The stock closed at lows yesterday, so if we get any less than impressive report, should we expect more downside?
Yeah, I'm looking at the pre-market here on the chart on Biogen right now, and it looks like maybe it's slightly higher. It's very thin in the pre-market, so we can't tell a ton. It does look like it's slightly higher. I'm not sure if the report's out yet. Not a ton of volume, like I said, so I think it's possible the report's not out yet, and that's just some erroneous pre-market ticks. But we go back to the daily chart of Biogen, and it's another one, similar story. It's actually held up a little bit better than the other ones the last 2 days. And then yesterday on that AMGN earnings, it traded down into its 8-day moving average, but was contained there. It was extended after this breakout from that. So this is one that potentially, if we do get a good report, I think, and if you want to be exposed long to the pharmas and the biotech names, then I think Biogen is one you could look to buy the dip as it retests this breakout price.
All right, but if you're looking for volatility, Gilead Sciences, wild action there, dropped 5% following the weakness in the group. Yeah,
it's another one that, and I don't trade the biotechs a ton, but I know the short-term guys, Mike Lee, Steve LeVay, Daniel Darrow, one of the new contributors to the virtual trading floor, all those guys have been watching these biotech names very closely because those guys crave volatility, and these have been providing that. And yesterday, if you look at the chart of Gilead, you saw a 2-day move down below the 8-day moving average, but it's also holding above the 21-day, sort of at an upper level floor here. If we do break it, we could get a move down to this sort of cluster of support around 48. The 50-day moving average is curling up. That could be another level that, if we do get more weakness here, that could contain the weakness in this sector. But I think this is just one traders are going to be watching. I don't think I have a very firm opinion or a lot of conviction about whether I think you buy the dip on these or whether you continue to look for more downside. But I think if you're a short-term guy, this is a place to look for volatility, and follow all those guys in the virtual trading floor that I talked about if you're interested in trading these names.
All right, time for some quick hits here. Let's talk Apple. Despite better than expected iPhone and iPad sales numbers and a share buyback plan, investors were not impressed. Apple closed slightly down yesterday. Do you think we'll head even lower there?
Yeah, the thing with Apple is that they generally issue very conservative guidance, and so the numbers, whether they beat or don't beat, it's really key to know what the whisper number is for Apple. And they did beat on the top and bottom line on EPS and revenues, but it wasn't a horribly impressive beat. They topped on iPad, they topped on iPhone, the big drivers, but it wasn't anything to knock your socks off and really compel you to buy it. And then the share buyback plan, it was good to see. It honestly was a little bit of a half-hearted attempt to placate investors that have been trying to get them to repatriate some of their cash, or at least return some of their cash to shareholders. But something I've talked about on Twitter and I've written about is that most of Apple's that's a Freudian slip right there. But most of Apple's cash hoard is abroad, and they would have to pay a 35% corporate tax rate to repatriate about $100 billion in cash that they have in foreign banks, and that's just not going to happen. So they did borrow to raise their dividend and to issue the share buyback, but I think because of the fact that they're going to end up having to borrow money to really return a lot of cash to shareholders. I mean, they did announce they're returning $150 billion by 2015, but I think people are looking for a little bit more and a little bit more aggressive capital plan, and obviously based on the price action, it wasn't enough to trigger a big move in Apple. And then the big thing that concerned people is the continued margin compression. You have a lot of people, for example, opting to buy or get the iPhone 4 for free when they get a cell phone plan rather than buy the iPhone 5, and they issued very weak guidance based on that margin compression, and growth is decelerating, and the stock basically, it's not compelling anymore for growth investors because growth is slowing and even shrinking a little bit, and from a value perspective, the capital plan was not aggressive enough to really get value investors interested. So if you take a look at this chart of this quick hit that's not becoming so quick, sort of like it was yesterday with Scott, but it was a crazy move in the last 48 hours for Apple, because after the report came out, people saw share buyback, they saw dividend raise, and the stock was up about 5% after hours after that report. But then in the same after hours, a few hours later, I was still at my desk and I saw Apple trade all the way down. It was down around 3%, and that's where it opened yesterday. But then right off the open, it ripped higher. It was at around 420. People were saying this is a bottom in Apple, this and that. And then craps out and it trades all the way back down near the lows. And we got a decent close in Apple that made it pretty much flat for the day yesterday after a lot of volatility. It's crazy that it actually it closed around 0.2% away from where it opened, just a small loss. But Apple's one that I think traders will continue to watch by default, and everybody has an opinion on Apple. I think on a long-term basis, I think it's a buy, but I think we could get some continued price action in this area until Apple's able to actually unveil some new products and get people excited again about something with the company.
Well, you get a pass for that. It's hard to keep Apple a quick hit. There's lots to talk about.
Yeah.
All right, let's check in on Lionsgate, because the stock was highlighted on Tuesday as a potential breakout. We did get a breakout yesterday.
Yeah, Lionsgate, it's not a sector that we talk about a lot, but we scan for patterns and we don't discriminate based on symbols. And Lionsgate, heading into the summer movie season, had a nice pattern. So we put two and two together and we say Lionsgate is one you could look to buy from momentum through highs. You look at the move in Lionsgate, tremendous move. Beginning of this year, it was a $16 stock, and it's been just a steep uptrend. And you talk about people looking for places to put money, and I don't know if it's because of the summer movie season, they think Lionsgate has some good movies coming out, or people just looking to put money to work in the stock market in sectors that aren't extended. But you see a nice breakout of a wedge pattern here on a macro level in Lionsgate, and then what we pointed out was a nice upper level flag, and yesterday we got a nice move through that level. And I know several traders on the virtual trading floor were trading it and took advantage of this move, and members of our community did too, I think also. So just another example of look for patterns, look for stock-specific action, and don't necessarily look to trade the broader indices.
All right, and Procter & Gamble saw a big drop of 6.6% after missing earnings expectations. So would you say that this could be a buying opportunity?
This is a sector that we've been talking about. It's the defensive type stocks have been leading the market higher for the most part during this move in 2013, which is, it's not an ideal scenario for traders because they like to see the high risk, the small cap, the tech type stocks lead. But we have to trade the market that we're in, and Procter & Gamble is one that has been one of those strongest value defensive names, and it went out on the highs on Tuesday. People expecting nice earnings from them, and it's, when you talk about consumer staples, it's sort of the staple of the consumer staples, for lack of a better word. But earnings came in a little bit light, a significant amount light of expectations, and the stock traded down about 6% yesterday and broke below its 8 and 21 day, obviously, and below its 50 day. But it's coming into this support level that we highlighted a while back as a base that people are potentially looking to buy Procter & Gamble out of. And I personally think we will continue to see money prefer to rotate into these defensive type sectors because there's a lot of issues still with the world economy. We have growth slowing in China. We have growth slowing here. In Europe, we have the debt crisis that's still an issue, and no matter how they want it to go away, they're kicking the can down the road, but it's not going anywhere, and potentially just going to get worse over the next few years. So I think people are a little bit risk averse in terms of putting money in the stock market, and these are the type of names that money will continue to rotate into, because even if we do get a correction, it'll be a more shallow correction, and there'll be less volatility in these names. So I think if you do get any more downside in Procter & Gamble, it's one that I personally would be looking to stash in a long-term portfolio, get nice dividend yield, less volatility in good times and in bad. But I think you'll continue to see that money rotate into the defensive names despite some pullbacks yesterday in that sector.
Well, so with that thesis in mind, then let's check in on gold. It's back on the move and trying to reclaim its 8-day.
Gold is sort of the anti-defensive value names. In a way, they're both sectors that maybe you look to put money in if you think that the world economy is going to have a lot of turmoil and there's going to be issues with inflation and things like that. That's a reason to put money in gold. And we've seen a nice resurgence from gold after this harsh 2-day down move. You don't necessarily look to buy into the 2-day down move because you don't know what it's going to lead to, but once we got a little bit of consolidation, a little wedge pattern that we broke above with this gap up, I think you could be comfortable starting to climb into a little bit of gold. You know, I'm not a gold bug. I'm not a macro super bullish guy on gold, but I think as part of a small part of a larger portfolio, I think it's wise to potentially own some gold. And you've seen a nice bounce back up into its 8-day moving average, and this morning, look at the 5-minute chart of gold. It's up nicely and continuing to rally in the pre-market. It's up above 140 now if we go back to the daily chart. So, you know, nice gap up here. This is the gap that everyone will be watching that gets filled around, you know, 143 area, 143, 144. So, you know, maybe it's tough to chase gold after a nice multi-day move out of this lower level wedge pattern that sort of formed after that harsh 2-day pullback. But in general, I think some exposure to gold is good, but I wouldn't be running to pile into gold at this point.
All right, well, today is a big day for earnings. What do you think you'll be focusing on heading into today's
we have
session?
Several after the close. We have Amazon in the tech space. We have Starbucks, you know, in the restaurant food industry, and then we have UPS in the transports, which will be very interesting to watch. The transports have been one of those sectors that was a red flag for a little while that's been able to bounce back a little bit, but UPS is generally seen as sort of a barometer for the economy to see how much stuff is getting shipped and the transports in general. That's the thesis there. But like you said, there's a lot of earnings that people are going to be watching. There's a lot of recent earnings like an Apple and the Biotechs and things like that people are going to be watching closely. So I think it's a very stock-specific trade. I don't think you pile into index funds right now. I don't think you pile into the S&P even though it has its sights set back on all-time highs. I think, if nothing else, the action in the last 2 weeks has proven that people are not terribly excited about piling into stocks at all-time highs. On a little dip, maybe people will put some money to work, but in general, I think you'd be a little bit neutral right now and take a very sector and stock-specific approach.
All right, sounds good. Happy trading, everybody. Have a great day.
I'm Evan Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, we teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.